Hello and welcome to this Vietnam economy case study. Me, Mr. Davis, I'm going to take an overview of the economy in Vietnam, look at its development, look at how its strategies it's doing to develop, as well as some constraints on its future development. And this is a good contrast with other countries we've looked at so far, like Ghana and China. So Vietnam is one of the fastest growing emerging economies in Asia. Officially classified as a developing economy, so you can use it as a developing economy in the exam. One of the key things, a bit like China, is become more market orientated. It's doing more reforms, 1986, opening up sort of free markets, and so similar to China, that export-led growth, major recipient FDI, but potentially here it's an alternative to China, as we'll see. And yes, unlike China, looking to move up the value chain more towards advanced electronics and IT potentially. So you can see that strong growth there. So you can see sort of before the pandemic, after the pandemic, you can see significant growth, often up 7 and 8%. This is due to the strong export-led manufacturing, FDI into the country, and therefore seeing export-led growth. As you'd expect, the external shock hit Vietnam massively as they're quite export dependent and trade was shut down at that juncture. So you saw 2020 and 2021 significant impacts with a good rebound in 2022, but significant rise in unemployment at that point. But as I said, a strong recovery since the pandemic, growth now around 8% and unemployment back to low levels. So a very strong economic performance, that strong growth driving them towards a developed economy status, but currently emerging economy. Inflation, well, moderate stable inflation. It's not been hitting like double digits, but it's certainly not down at sort of 2-1%. So moderate stable inflation. This is potentially due to demand pull inflation, due to the growth of the economy as we saw. It shouldn't be too much of a surprise to be growing at 8%. That inflation could be slightly higher than maybe in some developed economies. And there was some deflation during the pandemic due to the massive slowdown in growth at that point. In contrast to some of the other countries we have looked at, national debt actually is falling as a share of GDP. Why is that? Well, growth is very fast, so as a percentage of GDP, that's going to help if GDP is rising very fast. We're getting significant tax revenues as well from that growth, and quite controlled fiscal spending, maintaining that stability and that ability to attract FDI. So a contrasting country there in terms of we haven't seen any in the video so far looking at falling national debt as a share of GDP. So that's a good bit of context here for Vietnam. If you're looking at some policies you want to do, they do have the fiscal headroom to do some of these policies. As you'd expect from an export-oriented country, current account surplus is often the case. Now, obviously, the pandemic was a bit of an exception there, and we sort of saw 2022 as well. You see why growth was so slow at that point in 2022, because exports, current account balance hadn't really recovered to the levels it had done previously. So they are export dependent, and you can see like it is volatile, but you'd say they're a current account surplus country really, with exceptions. And a fairly stable inequality according to the Gini coefficients, and actually a bit lower than many developing economies. So that job creation has actually provided income across society and across the income distribution. Investment in education and rural areas, trying to also reduce inequality. And there's less extreme wages at the top end as well. So therefore, again, a good thing to know about Vietnam in terms of that stable inequality, but lower than many developing economies. It's worth knowing that. This is a comparison. We saw this in the Ghana video. So it's quite interesting to look at Vietnam versus China there. So you can see that big difference still in GNI per capita. I mean, China's an emerging economy, and Vietnam clearly not a developed country at this stage, given that GNI per capita. But HDI doing very well. You can see actually in some of the indicators of education, seeing they're actually better than China at this juncture. And then you can see the low debt as we saw, and gender equality actually similar to China as well. So the Human Development Index. So you can see over time a permanent increase in their development. There's the odd blip, but basically going up over time from 1990. That strong growth, boosting GNI per capita, investment in health and education. And you can see that big spike after the pandemic as well, as you saw a big rebound in terms of incomes, education access and life expectancy. I mean, Vietnam is ranked at 93rd globally in terms of HDI, which gives a good sense of where they are in terms of they're still a developing economy. So better than most developing economies, but not there with some of the advanced nations, the UK, the US, etc. Now, as you said, industrialisation is a key part, really, of Vietnam's economy. It's driven by those free market reforms, opening up to competition, opening up to foreign direct investment into Vietnam. So those industries, such as textiles, electronics, and assembly manufacturing, key. They actually had this Harrod Domar style growth, where higher savings led to more investment, because their savings rate was around 25 to 30% of GDP, allowing banks to lend, more investment, more capital, more growth, and becomes self-sustaining, and growth can take off. Obviously, they also had foreign direct investment to contribute to that investment as well. And you see on the right-hand side that increased share of the urban population. This is sort of showing that rural to urban migration. And this is seen in the Lewis model, isn't it, in terms of industrialisation, that movement of labour from rural to urban areas as the country industrialises. As a foreign direct investment, it's a great example of foreign direct investment. Look at those companies, you've heard of these companies, Samsung, LG, Intel, car manufacturing, Toyota, Honda, suppliers of Nike as well, and sort of textiles. So you can see significant foreign direct investment and some good examples you can use there. And you can see, Samsung's been there since 2008. And why is it attractive? So low labour costs. So lower labour costs now than China. A young skilled workforce. We saw that investment in education, and we're seeing the young workforce potentially starting to tip towards that demographic dividend. Access to trade in a very key area of Asia. China plus one. So some investors are looking to diversify away from just China, especially since the pandemic, when we saw the supply chains break down and people realised how reliant they were on China when China went into those second lockdowns. So looking to diversify where they set up. Infrastructure, not perfect, but improving, and government incentives to try and encourage. So foreign direct investment, coupled with industrialisation, these big drivers of export-led growth in Vietnam. But of course, there are other sectors as well. So tourism actually contributes around 9% of GDP in Vietnam, supporting jobs, earning foreign income. So the scenic landscape, low-cost destination, rich cultural experiences. So Vietnam, a great place to visit. And therefore you can see those tourist numbers ticking up. Again, the external shock of the pandemic really hitting them, but numbers are starting to recover, not quite up to the levels they were seeing before the pandemic, but certainly picking up. So the benefit there of tourism, it diversifies their economy. It's more income elastic, good when world incomes rise, but external shocks can be damaging. Some good examples of that. But as well as over-tourism, negative externalities, deforestation from over-tourism. So some of the issues potentially seen in Vietnam as well. But it's good to show something beyond just industrialisation for the economy. NGOs as well. So NGOs play a key role in Vietnam. So we can see some of the ones you've heard of, these Oxfam Save the Children. You can see Oxfam supported 50,000 people in Vietnam with climate resilience, sustainable farming projects. So big impact. But it is still smaller than the government and the private sector. So it's sort of filling in the gaps where maybe the government project they can't really get to, or there's issues in certain areas or certain parts of the development indicators they need to try and target. Maybe in countries like Bangladesh with BRAC, it's a much bigger, larger scale NGOs, but certainly can complement the government and the private sector. As with a lot of these things with support, there is that dependence potentially on foreign funding, coordination between all these different NGOs to get a good plan, whereas maybe a government could, in theory, could coordinate all of that, and maybe short-term projects can reduce the effectiveness. It's not sometimes as long-term as maybe the country would want. And sort of related to this is microfinance. So you've probably seen previously an example in Bangladesh where microfinance is that's where it was founded, Mohammed Yunus, the Grameen Bank. But you can see here it's reached 10 million people in Vietnam. So that microfinance, small loans to poor people to improve employment. You can see the VBSP there, the state-run microfinance institution, how much they've lent out. And it's often linked with reductions in poverty. So that fall in poverty, 58% to under 5% in the country, coupled with that low inequality, showing that maybe microfinance has made a good impact here. But some issues, maybe some remote areas not affected as much or impacted as much. And also, well, by definition, small loan sizes can restrict the growth of businesses. So, I mean, microfinance is very good at reducing poverty. It's got a good track record of that across many developing countries, but it's not sufficient. The same with the NGOs probably aren't sufficient, but they're trying to fill in gaps where potentially the government and the private sector haven't done everything to boost the economic development of the country. And then, like we saw in Ghana, we can see these different styles of development strategies. So Vietnam was a very state-led interventionist economy before 1986. Big role for state-owned enterprises at that point, big infrastructure, education spending and that side of things from the government. But there was that shift with the Dormoy reforms to a market-oriented economy. I think it's a great example of more market-oriented strategies. If you want a good example, I think this is a great one. Free market reforms, trade liberalisation, WTO membership, encouraging FDI, and you can see that export-led growth happening. But there's still a role for the government, price support in agriculture, managing the exchange rate, and still we're doing some spending on education infrastructure, and there still are some state enterprises, and there's also some protectionism still. So it is a balance, but it's moving towards market-orientated since the 1980s. So what could be holding back development in Vietnam, just to finish? So yes, infrastructure is improving, but there are some gaps. So energy shortages, power cuts could really constrain business growth. There's also some issues of corruption, bureaucracy, complex regulations, slow approvals as well may hold back investment. Labour shortages in some places, as well as rising wages. So that can affect the productivity of businesses, but also potentially that comparative advantage in low wages. And the aging population in future is predicted in a few years' time, there'll be a decline in the working population, and therefore that will constrain potential growth in Vietnam. They still do have that China dependence. I mean, Vietnam themselves, they're integrated into that East Asian economy, but they're still dependent on China. I mean, there has to be in some regard. And therefore, that is a risk for those, like any country that's highly specialised with trade and environmental pressures. And reliance on coal, that sort of non-renewable resource, could hit sustainability. So there is strong growth in Vietnam. It is developing rapidly. It is not yet a developed economy. Some of these reasons on this slide are showing you why, because of limited infrastructure, labour, and some institutional constraints. But say it's a good contrasting example, potentially with China, with Ghana, that gives you something else you can go to. But you're thinking about, when you're wanting that industrialised, FDI, free market-driven economy with low debt, low inequality, you've got a good example here in Vietnam. So I hope you found that useful, and that's all for now.